This supplemental lecture discusses the income statement, the profit and loss statement. And it's important to remember that the income statement is far more than a financial statement. It is a management tool that can be used and employed to manage and run a corporation. Let's first review the physical format of the P&L. As you can see, and as we will discuss, there essentially are three areas, three parts I would like to state associated with the income statement. Part 1, or the blue area on our diagram, essentially represents revenues and cost of goods. Revenues minus cost of goods gives us a very important metric we call gross margin. Gross margin represents the operating dollars available to a corporation, their cash flow dollars, over the fiscal period that can be and is employed to run the corporation. Part 1 of the P&L, therefore, is an operational element, an operational component. And we'll discuss a little bit further the supporting business processes associated with revenues and costs of goods and the associated measures and metrics that management would look at. Part 2 of the P&L effectively represents the expenses of the corporation. That is, expenses not related directly to the delivery, creation of the product and services. For example, marketing expenses, human resource expenses, IT expenses. Essentially, these are secondary expenses that the corporation incurs in running its business. For example, the payroll department as part of the accounting department. The payroll department is there to issue payroll checks to all employees of the corporation. They effectively have very little to do, if anything at all, with the production and delivery of the product. So therefore, they would appear in Part 2 of the P&L. And so in Part 2 of the P&L, we look at the gross margin dollars coming in minus the expenses, and this gives us a second very, very important measure, namely net margin. And net margin represents, if you will, the dollars we have available to us prior to expensing out overhead, interest, expenses, and taxes. Part 3 of the P&L essentially represents the overhead expenses of a corporation, specifically those expenses that can't be assigned or attributed to a particular department. So we may borrow X amount of dollars for cash flow so that we can cover shortfalls in the cash flow during a period in the fiscal. And as a result of that, it goes towards marketing, it may go towards production, it may go towards the accounting department or toward finance. So therefore, it's not really the interest expense can't be attributed directly to any particular department. So these are considered, if you will, overhead expenses, overhead costs the corporation incurs. And effectively, there are three of them. There are overhead. These, again, could be utility, rent. We rent the facility that is shared by many departments. Interest expenses on bonds, bank loans, and so forth. And then taxes on profits of the corporation. So essentially, Part 3 of the P&L represents this administrative overhead area. Basically, we take our net margin dollars, and from those net margin dollars, we subtract this overhead expense, we subtract this interest expense, and we subtract the taxes, thus giving us net profit, or as I often like to call it, triple net. The P&L also helps us to identify functional responsibility. For example, Part 1 of the P&L has two very important components. First, revenues. Revenues are basically dictated, obviously, by the sale of the products. But when we talk about the sale of the products, what are we really referring to? We're talking about the value proposition of a product to the demographic, to the customer that's buying it. What is the value? And the associated value will dictate the associated price. We'll discuss this in one of our later supplemental lectures on something I call EVAC. Associated with the value proposition, we have the corresponding price. The price relates to the value the customer has placed upon the product. Subsequent to the value proposition and the corresponding price, the marketing department obviously creates a series of projections, which is then used by the production department to produce the units that are going to be sold. So when we talk about revenues, effectively, if you will, this is a function of the product, the value proposition, the product features, capabilities, and needs that it satisfies in the market, the price associated with that product assigned by the marketing department, and the projections on the number of units that are going to be sold. However, Part 1 also includes the responsibilities associated with the production department, effectively the cost of goods. And the cost of goods are directly related to the material and labor costs associated with manufacturing or producing or providing the services and products. The key is this is part of, if you will, the supply chain. And so as a result of that, the production part plays a very important role in determining the gross margin. Yes, we have the revenue numbers, but if the cost of goods exceeds the revenue numbers, or if the cost of goods is too high, our gross margin is not going to be sufficient to run the corporation, to run the business. So therefore, when we look at Part 1, it really, its primary goal is to ascertain the gross margin dollars available to the corporation, or as is often called, the operating dollars available to the corporation to essentially run the business. And production is an integral part of that. The productivity of the labor, the productivity of the equipment, the productivity, if you will, and we'll discuss this a little briefly further on in the supplemental lecture, the business processes associated with the delivery of the products and services. So when we talk about P&L responsibility, what we're really talking about is what functional area essentially is responsible for managing that particular line item on the P&L. Regarding Part 2 of the P&L, there are many departments responsible for the associated expenses: research and development, marketing, IT, for example, human resources. Expenses are rent, which would be considered overhead, utilities, and so on. So the idea behind it is Part 2 represents all the expenses that are associated with a corporation doing business that are not directly related to the delivery of the product and service. And so the utilities, the light bill, for example, the phone bill, how do we apportion it to a particular department? And we can easily do that. If we can't apportion it to a particular department, then it's put in overhead expenses. So essentially, all of the expenses that are not directly related to the production, creation of a particular product or service appear either in Part 2 or Part 3. We effectively separate them to those that can be assigned to a functional department, Part 2, to those that cannot be assigned to a functional department, Part 3. So we may be able to have, for example, let's say we have a building dedicated to the IT department. Well, in that case, in all likelihood, we could probably associate it, the cost, the rent, if you will, and the utilities with that to that department, to the IT department, and therefore it would appear in Part 2 as opposed to being in Part 3. But then we also may have software, for example, payroll software. The problem with then looking at payroll software, is that an expense of the IT department? The answer is no, it's not. That is really an expense that essentially is across the boundary of different departments, and as a result, that would more than likely appear, if you will, an overhead expense. But this is where a company's auditors, this is where a company's accountants would come into play to ascertain. Irrespective, our goals and objectives are always to continuously reduce expenses. Expenses in Part 2 and expenses in Part 3. expenses in Part 2 net us what we call net margin. This effectively represents the operating dollars, gross margin dollars, minus the expenses assigned to a department, as opposed to the net margin overhead dollars, if you will, in corporate interest expense and the taxes, giving us triple net. So essentially, Part 2 and Part 3 are similar in nature, but different in the sense of how these expenses and who are these expenses assigned to. Now that we understand the P&L responsibility and which area of the profit and loss statement falls in, the next step, the next area of interest is to associate the business processes of a corporation. And as we are aware, there are two sets of business processes: primary business processes, which are associated with the activities to create and deliver the product of the corporation or the service, and secondary business processes, which essentially are there to support those who are delivering and creating the products and services of the corporation. From a P&L perspective, as we can see, the primary business processes fall under Part 1, revenues and cost of goods. Basically, cost of goods is the production of these products. So we have, if you will, our chain, our set of activities that takes, if you will, for a manufacturer, the raw materials, converts those raw materials into finished goods, sends them off to the distribution centers, and from the distribution centers to the resellers, and so on and so forth. In terms of a wholesaler, the purchase of the products, the storage of those products, and in terms of retailers, essentially the purchase of the product and the display. So basically, the primary business processes are associated with Part 1 of the P&L. The revenue component, the advertising, the marketing, if you will, the pricing of the product itself, the promotion associated with the awareness of the product, the accessibility, that is the salespeople, where to go about doing, purchasing the product and so on, and subsequently the production or cost of goods, if you will, of that product, of that service, whatever the case may be. So when we think of business processes correlate primary, vertically oriented, product specific, service specific, essentially are mainly in Part 1 of the P&L. The other set of business processes are secondary business processes or supporting business processes. That is, the way we define these supporting business processes is that they are not directly related in any way to the production, creation, or delivery of the products and services of the corporation. They are there to support those primary activities. Thus, we classify them as secondary. And they fall into two components, two aspects: functional, departmental, as well as corporate. And as with the actual expenses themselves, the business processes that we can directly relate to the department are in Part 2 of the P&L. Those that are for the entire corporation, we have in Part 3. So when we look at Parts 2 and 3 of the P&L, and we look at the business processes that are associated with those two sections of the P&L, they are the business activities that take place within a corporation that are not directly related to the delivery of the product and service. For example, payroll. Payroll is a function in every corporation, irrespective of whether we are manufacturing automobiles or TVs or we're manufacturing apparel. Every individual in the corporation is expecting a paycheck. That is performed by the accounting department, sub-department we call payroll. Human resources, HR. Every corporation has a human resource department. The activities of the human resource department are the same, irrespective of whether we are producing automobiles or refrigerators or we're providing accounting services. HR is there to determine the benefits packages for the employees, to manage the accruals of the vacation, sick time, for example, as well as reviews and all other aspects. Again, this has very little to do with the vertical market of the corporation. Now, the reviews, specific reviews that are associated with the primary activities are performed by management in those areas, but they are record collections stored by the Human Resource Department. So when we think of business processes that are not related directly to the revenue and cost of goods, pretty much we're talking about all the other expenses of the corporation. As we will see, our objectives and goals are to drive the cost of goods down in part 1 while increasing revenues. We have a similar objective in parts 2 and 3 to drive expenses down. Now, these expenses are not constrained by the quality of the product, the features of the product. These expenses are expenses that the corporation incurs. So if we could drive the payroll dollars down as close as possible to zero, we're doing our job, which is why many corporations, for example, outsource payroll. Since payroll, a secondary or supporting activity, does not directly correlate to the product that is being sold and thus to the features of the product. So we can easily and safely outsource this, possibly at a much, much lower cost. So it's important to remember when we think of a profit and loss statement that we understand where the primary activities, that is the vertical market activities, reside and are shown, and where all of the other expenses incurred by the corporation are illustrated, parts 2 and parts 3. The P&L is also an excellent management tool, a reporting document that helps management essentially control the corporation. By monitoring the appropriate measures on the P&L and their associated metrics, the company can manage change. The company can ascertain if it is succeeding, if it is performing as it had expected. There are a number of measures, as we've discussed, on the P&L that are extremely useful to us. The gross margin, the net margin, the triple net or net profit. These are all extremely important measures that we can use to help us manage and control the corporation. In the capstone simulation, for example, the gross margin exceeding 30% is a sign the company is doing very well. And so management looks at the revenues and costs of goods to ensure that the GM is greater than 30%. Now, this will vary depending upon the vertical industry. The GM in some industries, such as software, for example, may be considerably higher than the GM in hard goods industries. So the key is we may have a measure such as gross margin, but what may vary between the industries is what would be considered a successful metric. In a similar perspective, we have the net margin. Again, in the CAPSIM simulation, a net margin between 10 and 15% is considered very good. The company is doing well. The company is achieving its goals and objectives. Again, as stated, depending upon the vertical market, the vertical industry the company is, the net margin based on historical trends will be very different. So corporations that are in established industries essentially have historical metrics in which they can rely upon to help them monitor the corporation, at least at a corporate level. And what is it we monitor? We monitor the measures and the corresponding metrics. And if for some reason these measures and their associated metrics are not within the acceptable values, then we proceed to manage. And essentially that is the job of a manager, is to continuously look at the measures and metrics associated with the areas of interest, that is the success of the corporation, and essentially to act if those measures are not being met. As we have briefly discussed, the P&L is an extremely important element in management, and all managers should be well versed in its employment. This concludes the supplemental lecture. If any of the information or topics or concepts that have been discussed is unclear, we have additional supplemental videos that you can employ to refresh your memory on these various topics, on these various concepts. Please employ them so that you feel extremely comfortable in the usage of the P&L.